Stocks listed in Singapore, they are Nam Cheong and Tiger Airways. Buy, hold or sell? Let's hear from one market watcher. My guest tonight is Sir Saka, Assistant Vice President for Equity Research at DBS Vickers Securities. Let's start with Nam Cheong. You have a buy call and a target price of 24 cents on the stock. Nam Cheong plans to complete and sell 18 vessels in fiscal year 2012. That is up from 13 vessels in the previous year. Is the company being a bit too ambitious, especially in this environment?
Hi. Well, the first thing to note here is, of course, the company has almost sold off the entire 18 new builds that you were talking about for this year. And we think this is very much in line with the industry fundamentals in the offshore oil and gas sector, which is in quite a sweet spot at the current moment, with oil prices well above $100 per barrel, Brent crude prices, and the capex plans for all the big oil majors are continuing in line with their schedules. So we think that this year-on-year increase is generally quite in line with the strong industry fundamentals, and the growth is very well premised on the oil capex plans by the big companies going forward.
Clearly, in the cyclical oil and gas industry, what are some other risks that investors should be aware of?
The other key risk is, we would say, availability of financing for their customers. Yeah, so the credit availability for their customers. If that is not there, then obviously there will be a dip in demand.
Let's move on to Tiger Airways. You have a buy call, and for September, a target price of 90 cents for this stock. This is 2 cents less than the target price in August. Why have you lowered your price?
This is largely to factor in some impact from the higher domestic competition in the Australian market, where there's a price war going on between Qantas and Virgin. So we have factored in slightly lower yields going forward, and hence we have lowered the target price.
As we move into October, we will see the usual seasonal uptrend in fares. However, Tiger Australia, with its small share of the domestic market, is a price taker at best. Where do you expect the airline to find revenue-boosting opportunities?
As you said, the second half of this year is a seasonally stronger year, period, and we expect Tiger to benefit from better pricing. That said, we think that they should be spreading out their assets more in Australia, so they could probably shift some of their aircraft from busier routes like the Sydney-Melbourne route, where it's more competitive, away to the more niche kind of regional routes like, for example, say routes to Mackay, Rockhampton or Canberra before the holiday season comes in, and this should help them get better yields and revenues in the upcoming peak season.
Sir, thank you for your analysis. I have been speaking with Sir Saka, DBS Vickers Securities.